$35 to $850, $250 to $1,900, $1,050 to nearly $4,800. When I look at numbers like that, I do not start by asking how high gold can go next week. I start by asking what happened before those moves began, because markets rarely hand you the full story in the move itself. The move is the reward. The real money is made in recognizing the setup that comes first. And with gold, across nearly a century of monetary stress, the setup has been surprisingly consistent. Not 2 signals out of 4, not 3 if you are being generous. 4, the same 4. Every single major gold explosion in the modern era was preceded by the same structure. That is why I think this moment deserves real attention. Not because gold is magical, not because fear sells, but because I believe all 4 signals are flashing again. And when that happens, I stop treating gold like a side topic and start treating it like a warning light on the dashboard of the financial system. So let us begin with signal number 1. The debt burden reaches the point where it cannot be repaid, honestly. That is the starting point every time. And I want to be precise about that word, honestly. Governments do not need to announce that they are bankrupt in order to be functionally cornered. They simply need to reach the stage where paying back the debt in money of equal purchasing power becomes mathematically and politically impossible. At that stage, there are only a few options. One is default. That is the crude version. A country says directly or indirectly, we cannot or will not pay as promised. Developing countries do this from time to time. They restructure, they break terms, they force losses. It is ugly and obvious. Advanced governments dislike doing that openly because it destroys trust too visibly. So they use the second method. They make the money worth less. That is the cleaner political option. You still get repaid in nominal terms. You just do not get repaid in real terms. That is how the game is played. Now look back at the 1930s after World War I. After the Depression, the debt burden and the economic strain became too large to work through cleanly. The government could not tax its way out fast enough. It could not grow its way out fast enough. So it changed the terms of money itself. Gold was revalued upward. The dollar was devalued against it. Anyone holding dollars discovered that legal repayment and real repayment are not the same thing. Then look at the 1970s. The United States had written checks. The underlying system could no longer cash. Domestic spending had expanded. External pressure had expanded. The gold backing behind the currency promise was no longer credible. So the authorities did not tell the public the simple truth, which was that the arithmetic no longer worked. They changed the architecture instead. Then look at the post-2000 era and especially after 2008. Debt doubled. Financial institutions were backstopped. Insurers were backstopped. Mortgage exposure was backstopped. The entire system was carried through by expanding the liability side of the state and then socializing the stress. And now look at today. Debt is moving toward levels no serious person believes will be repaid in money of unchanged value. That is the point when debt reaches a scale where the burden cannot be carried. Honestly, gold starts paying attention before most people do. Now signal number 2 is what always follows. The rules get changed. This is the part ordinary savers never expect, because they still think the monetary system is some neutral referee. It is not. It is a rule book written by the same people who are trapped by the debt problem in the first place. Once the debt can no longer be handled cleanly, the rules of money get rewritten. Franklin Roosevelt did it bluntly. He made private gold ownership illegal, confiscated it, and then revalued gold upward. In other words, the government took the asset and then changed the official price. That is not a free market adjusting. That is the state rewriting the contract between citizen and currency. Then Nixon did his version. He did not say the dollar was broken. He said the gold convertibility promise was being suspended. Temporarily, of course, governments love temporary language when they mean permanent structural change. The gold window closed. The dollar fell. Gold went from $35 to $850 over the following years. The rules had changed. Then after 2008, the rule change arrived in modern technocratic language. Quantitative easing. A very respectable phrase for a very old behavior. Money creation, the authorities did not call it debasement. They called it liquidity support, balance sheet expansion, emergency stabilization. But the practical result was the same. Trillions appeared, assets were purchased, and the monetary regime shifted. Now look at what is happening today. The exact labels are different, but the pattern is familiar. Stablecoin regulation is being tied to demand for government debt. Policy channels are being shaped to create new buyers for Treasury paper. Rates are being handled in ways that would make little sense if price stability were truly the sole objective. The rules are shifting again. Not in one dramatic Sunday speech like Nixon, more quietly, more bureaucratically, across multiple channels. But that is how modern policy works. It avoids the one giant confession and replaces it with 1,000 small adjustments. That is still a rule change. And every time the rules change because the debt problem got too large, gold notices. Now, signal number 3 is the one that hits ordinary people most directly. Cash and supposedly safe savings start losing money in real terms. That is the point where the responsible saver discovers that responsibility has been weaponized against him. People still think that if the number in the bank account is going up, they are moving forward. They are not. If your bank pays you 2%, 3%, maybe 4%, while the real cost of living is rising 6% or more, then your balance is growing nominally while your purchasing power is shrinking in reality. That is not savings. That is managed decline. This is what happened after Nixon inflation surged. Savings did not keep up. Bondholders got punished. This is what happened again after 2008 in a different form. Rates were suppressed. Real returns were miserable. People lending money to the state were effectively being asked to accept less than the purchasing power they started with. And here again we are in the same neighborhood. Rates may look respectable on paper compared to a few years ago. But the question is not the number on the statement. The question is what your money can still buy. If food, rent, energy, insurance, services, labor, and all the other things that actually matter are outrunning the return on your cash and your fixed paper, then you are not preserving wealth. You are transferring wealth from savers to asset owners. That is the mechanism. And once enough people realize that holding money is the losing side of the system, their behavior changes. They stop wanting paper claims so much. They start looking for scarce things. That brings us to signal number 4. The central banks themselves start buying gold. This is the part I always find most revealing, because central bankers can say a great many things. They can publish reassuring research notes, they can hold conferences, they can tell the public inflation is transitory, manageable, misunderstood, or being monitored very carefully. But then they go and buy gold that tells you more than the speeches do before the official break in the 1970s. Foreign governments were already converting dollars into gold because they could see the system was strained. After 2008, central banks shifted from net sellers to net buyers. That was not an accident. That was a vote of no confidence in paper promises, and now we are watching one of the strongest central bank gold buying cycles in modern history. Countries across the world are diversifying reserve exposure, building hard asset buffers, and reducing blind dependence on the dollar system. Again, the rhetoric may remain diplomatic. The action is not ambiguous. When the institutions closest to the monetary plumbing start swapping paper for metal, they are telling you something. They are not trusting the current setup to remain stable in real terms. Now, line up the 4 signals. Debt moves beyond honest repayment. The rules get changed. Real returns on savings go negative. Central banks start buying gold. That sequence showed up in the 1930s. It showed up in the 1970s. It showed up after 2008, and it is showing up again. Now, that does not mean the exact same percentage move repeats. History does not owe us theatrical symmetry. It means the underlying monetary conditions that have historically launched gold into major repricing cycles are back in place. And that is why I think serious investors need to pay attention. Now, before anyone gets carried away, let me say what this is not. This is not a get-rich by Friday story. Gold is not a meme stock. It does not care about your impatience. The 1970s move took years. There were brutal drawdowns inside that bull market. At one point, gold fell almost 50% for an extended stretch, right in the middle of one of the greatest moves it ever had. That matters because it means conviction without risk management is just another way to lose money. I have seen far too many people turn a sensible asset into a religion. They go all in, they stop thinking, they stop sizing risk, they stop diversifying, they act like owning gold is a moral identity rather than one part of a portfolio built to survive multiple futures. That is foolish. This is an investment question, not a cult question. So how do I think about position here? I still think the core of most portfolios belongs in productive assets. Stocks remain a large part of that because productive businesses are still one of the best long-term defenses against currency debasement. If you own them intelligently, real estate can matter too for those who understand the asset and the local economics. And then there is the metals sleeve. I think that deserves respect. Now, not blind worship respect. Some people are comfortable with 10%, some with 15%, some with more. The point is not that there is one holy number. The point is that if the four signals are flashing, owning no exposure at all is its own decision, and probably not a wise one. Then there is the question of how you own it. The simplest route is direct gold exposure through liquid vehicles that track the price. For many people, that is enough. It gives them the monetary hedge without making storage, transport, or security their new hobby. Then there is the higher risk, potentially higher reward route. Gold miners, the economics. There are straightforward enough. If a miner can produce an ounce for a relatively fixed cost and the gold price rises, the profit per ounce can rise much faster than gold itself. That operating leverage is why miners can outperform the metal in a strong gold bull market. Of course, that same leverage works in reverse when the cycle turns, or when management is poor, or when costs rise. So miners are not just gold with extra upside. They are a different asset entirely, and people who buy them casually often discover that too late. This is why I always come back to the same dull but essential principles. Diversification matters, position sizing matters, risk management matters more than conviction. Everyone wants the dramatic call. Very few want the discipline that makes the dramatic call survivable. So let me reduce the whole framework to its simplest form. Gold tends to explode when governments can no longer manage debt. Honestly, when they start rewriting the rules, when real cash returns turn negative, and when the central banks themselves start fleeing paper with their own actions. Those four signals are not random. They are the monetary system telling you stress has reached the stage where trust must be replaced with debasement. That is when gold starts repricing. You can ignore that, if you like, most people do, until the move is already well underway, and the same people who mock gold suddenly start asking whether they are too late. I would rather understand the setup before the crowd gets there, not to become hysterical, to become prepared. That is the whole point.